Hello and welcome to the Fit Finance Sessions with me, Henry Elliston, Tom Senegals and Tim Webb. And today in our ongoing series of introducing you to financial concepts, what they are and what they mean, today we're going to talk about capital gains tax, mainly because our portfolios have all done so well over the last week on the back of the vaccine and the presidential election that we're now wondering what to do with all these profits and how we're going to be taxed when we come to sell some of the investments that we own. So to start with, Professor Webb is going to explain currently how capital gains tax is calculated and what the rates of tax are. Tim, over to you.
Indeed, yeah, that's fairly straightforward. Essentially, it's just how much you paid for the asset. So let's just use a share, for example, not an ISA or a pension. Let's say you paid £100 for this share. That's called the base cost. And then whenever you come to sell the share, let's say that's £200. And that's effectively so current value. And then it's so whatever you've sold, so the sale price, if you will, sale price, and the difference between that sale price and the base cost, how much you paid for it, essentially. And that gain, if it is, assuming it is a gain rather than a loss, is then assessed against your capital gains tax allowance, which is currently 12,300 British pounds per tax year. You can't carry it forward, unfortunately, so it's a use it or lose it jobby, similar to the ISA allowance, and that's it. And then if you've used up that capital gains tax allowance, what tax rate you're taxed from that point is independent on your earnings. So if you're a basic rate taxpayer, then you pay 10% on the excess over your allowance, or 20% if you're higher or additional rate. But if we're talking about property, then there's an additional 8% on top of those. So again, basic rate then becomes 18, and the other two become 28%. And that's it, broadly speaking.
So it's pretty straightforward. So the profit you made on any investment, taxed at either 10 or 20%, unless it's the buy-to-lets.
Yeah.
You mean. But it is, Tim or Tom, you might argue, a little bit complicated to have these 4 different rates of tax when there are so many other rates of tax that we have to pay, like the 20% rate of tax of income, the 40, the 45. What would you do, Tom, to combat all this confusion in the tax market?
Well, the Office for Tax Simplification has come out this week or last week, suggesting that they're going to reduce those 4 bands down to 2. And whilst actually capital gains tax has probably been the best tax to pay if you think it relative to income tax over the last few years, it's also one of the taxes that would probably be politically easiest to raise with all this government expenditure. So there is a lot of talk about potentially aligning that to income tax levels. So if you pay 20% income tax, you pay 20% capital gains tax. But the other suggestions have been to reduce the exemption Tim was mentioning from 12,300 down to 2,000 or 4,000, and also remove the uplift rule. So currently, if you pass away, then capital gains die with you, and your beneficiaries inherit those assets at a new base cost at the date of death. But what they're saying is actually those gains will continue, and the beneficiaries will pay the gain on the entire acquisition from the very start. So that could mean for some families that actually gains are accruing across several generations, which has some issues, making that people won't sell assets because of that. But also, I think some very wealthy individuals are able to basically, maybe disguise is the wrong word, but attribute their earnings or their income to capital gains rather than income tax. So if you think of people working in private equity, a lot of them will receive remuneration in the form of carried interest, which is taxable against capital gains rather than income tax. So it's about bringing, say, very wealthy individuals who are earning their money through capital gains tax into a more aligned scheme. But just bringing the exemption down to £5,000 will double the amount of people that actually pay capital gains tax. So for quite a lot of our clients, they won't be paying capital gains tax if they have a portfolio that is taxable outside of ISAs or pensions. But going forward, that might not be the case. If you want to combat that, then A, make use of those allowances. B, we harvest capital gains for our clients. So if gains build up, then we sell assets every year, purchase other assets, stay outside for 30 days and sort of reset that base cost Tim was talking about. But it might see a return of the use of offshore bonds and other sort of structures that allow you to effectively roll up the returns gross, not pay them every year, and then basically choose to pay those gains at times that suit you or your tax position. So we might see a return of using those structures as well.
Yeah, I mean, it's to my mind, it's certainly the idea that you don't rebalance a base cost on inheritance. It's a little bit concerning because potentially you're already paying 40% inheritance tax on the receipt of that asset, and then possibly, I mean, more often than not, this may well be a house that you're inheriting. You then pay another 28% just because you decide to sell it immediately afterwards, or perhaps even to settle the inheritance tax liability. So it'd be interesting to see what rules come about there. I know the government is not particularly fond on property investment right now, and this perhaps becomes just another nail in the coffin of the accidental landlord.
Yeah, I think under those rules, you could end up paying 40% inheritance tax and then 45% capital gains tax if they align them to income tax rules. So yeah, it's going to be pretty punitive. I think the good news is the government's pretty good at ignoring the Office for Tax Simplification as well. They've previously done that with other inheritance tax rules. I think someone in the Treasury described them as a bunch of wonks the other day. So that probably tells you how much they listen to them. But I think given the Tory party have put in their manifesto, they won't change income tax or national insurance. Capital gains is largely on the wealthy. There will probably be some reform. I don't think it'll be as bad as what they're suggesting, but yeah, I think it's just important that if you are thinking maybe coming out of a property portfolio, maybe think about selling those sooner rather than later, really.
Yeah, absolutely. And of course, any changes when they're made, you'll be sure to be updated through the Fit Finance Sessions podcast just as soon as we know any more about it. That's all on capital gains tax this week. I hope you found that interesting and not too worrying. You'll have plenty of time to order your affairs beforehand if any changes are made. But until next week, thanks very much and bye-bye.